In this session, we'll look at the fascinating world of money and finance. Despite our earlier assertion that economics isn't solely about money or becoming wealthy quickly, it is fundamentally about exchanging your possessions for the items you desire. Consider this substantial zucchini I have here. Would you be willing to trade it for a slice of that delectable pizza? Well, maybe not. The challenge of a moneyless world. Consider yourself a dentist looking to buy a car in a world without currency. Your first task would be to locate auto workers in need of dental care or TV manufacturers in need of dental care. Bartering under this system can be time-consuming, especially if such exchanges are attempted via platforms such as Craigslist. This method of exchange is commonly known as the barter system, and it requires a significant amount of time and effort. Nonetheless, for the vast majority of transactions, we rely on currency's efficiency. 3 key functions of money. People in genuine need of dental care usually compensate you with money, which you can then use to buy a car. Economists emphasize that money serves 3 primary functions. For starters, it serves as a medium of exchange, which is universally accepted for transactions involving goods and services. This trait frees us from the constraints of the barter system. Second, money functions as a store of value. This distinguishes it from perishable items such as fruits and baked goods, which cannot be saved for large purchases such as cars. Furthermore, money functions as a unit of account because we don't value items in terms of bananas, muffins, or dental procedures. We use money as a standardized measure to determine their relative worth. Money beyond cash and coins. Many people associate money with paper money and government-issued coins. While coins have a long history as a prime example of money, it's important to remember that money includes anything that can be used as a medium of exchange. Cigarettes, for example, were used as currency in prisons until smoking restrictions were imposed. Postage stamps and even small packages of mackerel have taken on this role in modern prison economies. Furthermore, various items such as livestock, grain sacks, feathers, shells, and even massive limestone discs known as rye stones on Yap Island in the Pacific Ocean have served as money in various societies. The main point is that economists define money as anything that has value as a medium of exchange, a concept that has evolved significantly over time. The digital transformation of money. While cash and coins are still in use in modern society due to their physical convenience and resistance to forgery, a significant portion of our financial transactions are conducted digitally. Many people receive their income in the form of checks or direct bank deposits, which means that a significant portion of money is purely digital and resides within financial institutions' computer systems. Furthermore, Bitcoin, a decentralized virtual currency, has gained popularity as an alternative form of money that is not bound by the laws of any particular country. Its allure stems from the possibility of anonymous transactions, which appeals to both those wary of traditional banking systems and those involved in online illegal activities. However, Bitcoin's speculative nature, with many people treating it as an investment, prevents it from being widely adopted for everyday purchases. The possibility of Bitcoin or another virtual currency dominating future transactions remains uncertain, putting money's future in jeopardy. As for me, I'm willing to accept 10 Bitcoin in exchange for the zucchini. The role of confidence in currency. An intriguing question arises: what gives these paper notes their value? Historically, each dollar issued by the United States government was redeemable for a specific amount of gold, a system known as the gold standard. The government's money issuance was limited by its gold reserves under this system. The United States chose to abandon the gold standard in the 1930s, raising concerns about the lack of tangible backing for our currency. However, it is critical to recognize that the value of money, whether in the form of cash, gold, or even small packets of mackerel, is dependent on public trust. According to Nobel laureate economist Milton Friedman, the value of those green paper pieces exists because everyone believes in their value. Adopting a gold standard, or even a mackerel-based standard, may not necessarily improve the value or reliability of currency, according to this viewpoint. Most economists agree with this viewpoint, which explains why no nation currently uses the gold standard, despite occasional political calls for its return, albeit with little chance of implementation. Please accept my apologies to Ron Paul. The role of banks in the financial system. While we previously stated that economics is more than just the stock market, It is now time to delve into what economics entails and why it is important. The stock market is only one component of the larger entity known as the financial system. To understand this system, consider two distinct groups: lenders, which include both large corporations and ordinary households like you and me, and borrowers. We, as ordinary people, frequently require funds for future needs such as retirement, education, or even leisure. Borrowers, on the other hand, include individuals seeking loans for items such as homes or cars, businesses seeking capital for innovative ventures, and governments facing budget deficits. The financial system serves as a network that connects these two groups through institutions, markets, and contractual arrangements. Lenders deposit funds into the system, which are then lent to borrowers. These borrowers pay back their loans with interest, making it a profitable venture for lenders. This financial interaction is facilitated by three primary channels. First, there are banks, where lenders deposit funds, which the bank then lends to individuals or businesses in need of financial assistance. Borrowers' interest payments cover a portion of the bank's costs, with the remainder going to depositors. Second, when governments or large corporations require loans and issue bonds to lenders, the bond market comes into play. Bonds are a promise to make regular interest payments and repay the principal amount at a future date. If a lender prefers immediate cash, the bond can be freely sold to another party. Finally, there is the stock market, where entities such as businesses can issue shares of ownership, stocks, to households in exchange for capital. If the company succeeds, shareholders will benefit from profits or be able to sell their stock at a higher price. These distinctions are critical. Banks and bonds primarily deal with debt with predetermined repayment terms, whereas stocks represent equity with variable returns based on a company's performance. The Dow Jones Industrial Average is frequently mentioned in the news, but it's important to remember that stock market fluctuations do not always reflect overall economic health. Stock market movements are frequently triggered by genuine or perceived changes in economic fundamentals, such as consumer confidence, unemployment rates, and GDP growth. Despite their differences, bonds and stocks have one thing in common. They are both traded on financial markets with a large number of buyers and sellers. Banks, on the other hand, act as financial institutions, safeguarding deposits while making loans to individuals and businesses, with the help of entities such as the FDIC to protect our funds. Diversification in lending and borrowing. What is the rationale behind this complex financial system? And why don't households lend out their savings directly? If you want to lend your entire life savings to your neighbor for his artisanal smartphone venture, you can, but it comes with significant risk. As a result, the preference for using a financial system. Financial markets, which include instruments such as stocks and bonds, provide a platform for borrowers to pool funds. They raise capital from a diverse group of investors, spreading the associated risks. Banks follow a similar principle. They collect small deposits from a large number of people and use the money to make loans. It's similar to Kickstarter, but with monetary rewards rather than heartfelt thank you emails. Diversification is possible for lenders because the financial system spreads savings across multiple loans. While some businesses may suffer financial setbacks and individuals may default on their loans, borrowers who meet their repayment obligations mitigate these losses. It essentially eliminates the need to devote all of your financial resources to a single project. Money's role in the financial system. This refers to money in the financial system. It's critical to understand that this isn't just an abstract concept or something that doesn't directly affect us. In reality, most of us play the roles of both lenders and borrowers at some point in our lives, and understanding these dynamics is critical. Even if it appears that you're borrowing from a faceless entity, there's a chance you're borrowing my funds from the same faceless entity, and I'll definitely need it back if I can't find anyone willing to accept this courgette as payment. Thank you for being here with us today. We hope you found this video engaging and insightful. Don't miss out on our latest content, subscribe to our channel, and hit the bell icon for updates.